Hello everyone and welcome. Today I want to follow on from what was our short 3-part series highlighting what we believe to be a sensible way to invest your money. Last week I briefly highlighted how Wells Gibson builds portfolios for our clients, and this week we're going to look more closely at higher risk growth assets, which we regard as the engine room of your investment portfolio, which is likely to fund your financial future. The growth assets in our client portfolios are a sensibly constructed, globally diversified mix of risk assets that seek to deliver strong after inflation returns over the medium to long term. At the core of our allocation to higher risk growth assets are equities from developed markets such as the US, UK, and Germany. We also include a moderation to equities from emerging markets such as Brazil and South Korea, as well as smaller companies and less financially healthy companies, because we expect them to deliver higher returns on account of them being riskier than larger companies and more financially healthy companies. We also seek out other asset classes which have an expected return, as we feel it's important to reduce some of the equity risk, but without sacrificing too much in the way of returns. An example of this is global commercial property, which is a useful addition. Remember this: most of your portfolio's return will come from the market and not from market timing or attempting to pick winning fund managers or shares. If you want to capture the returns from the market effectively and efficiently, diversification is vital. As a result, the growth assets component of Wells Gibson's portfolios are highly diversified across asset classes, countries, industry sectors, and companies. In fact, our most recent analysis revealed Wells Gibson's portfolios contain exposure to several thousand companies in around 40 markets. Of course, this part of your portfolio will be volatile, but should always be expected. Negative returns are likely in around 1 in 3 annual periods. However, remember that although that's the nature of capital markets, market volatility is always temporary though. Remember also that a fall only becomes a loss if you sell, and that's something that patient and disciplined investors should avoid. Next week, we will look at how you can balance your portfolio with lower risk defensive assets. Thank you for watching, and please visit our website at wellsgibson.uk. Thank you.